what do you make of all of this big, otherwise risk-off move, the big move in bonds and in stocks today and this week?
Yeah, I'm going to agree with Barbara. I think that the problems here are not a health problem. I'm not worried about the health of the American public or my own personal health as well. But the fact that they are announcing that a 14-day quarantine for anybody who's been to Hubei province or self-quarantine for anybody who's been to China says the whole country of China needs to do that to get beyond this. And that's going to have enormous economic implications as you take the second largest economy and disconnect it from the global economy for a period of several weeks. I think the markets are sensing the economic damage that this could do more than the health damage that it poses.
Yeah, Jim, I mean, I guess if you look at the 10-year yield at 150, what is that telling you? Is that the economic weakness story?
Yes, because the yield curve has inverted. It is below the 3-month bill. I've used the simple definition of the inverted yield curve means that the market, at least today, thinks the Fed funds rate is too high. The question is, when does the Fed come around to that thinking and start really seriously thinking about cutting the funds rate? Well, as we stay with an inverted yield curve in the next week, if we stay in it in the next week and the week after, then I think that then a Fed move will come onto the table as well, too. And that might actually also reinforce the idea that there's a dramatic slowdown underway.
You know, you saw the dollar move earlier today, Wilfred, you mentioned. It really, the market started moving after the Chicago PMI number and the weakness. That was a surprisingly weak report, and that's where we saw the dollar. The stock market kind of fell out of bed, buying of bonds. And this view that, you know, things were looking good going into the year, and now maybe they were on a shakier start.
It's literally the way it is. At the highs, it seems like you can do no wrong, and the consumer looks great. Earnings are on the upturn. Credit markets are perfect. Flows into stock funds. Volatility is low. Why wouldn't it be great? So when things start to turn, you start finding things that all of a sudden don't look as wonderful. And obviously, you know, Midwest manufacturing, in other contexts, we could have written it off. Bernie Sanders high in the polls in another week. Maybe that's just noise. But it seems like one thing on top of another. And market sell-offs are like Murder on the Orient Express. Everybody did it in the end. Everyone was the murderer, even if only one did the killing.
Barbara, where do you want to be positioned in terms of the growth stocks versus the safe havens in this environment? Is this the opportunity to get back into the growth stocks?
I think so. I think ultimately it will be, because I think that's been the conundrum. You've had all these, you know, stocks have run and run and run, and where do you get in? If you missed Apple or you missed Amazon, when do you get in? And I think an opportunity will come up, because I think the defensives, they're pretty fully valued. Like Colgate today reported great numbers, but the stock is fairly valued. So, you know, where do you go? I think it'll be an opportunity to rotate back in.
Ben, is this a buying opportunity in your eyes?
Well, first of all, hard to overstate the gravity of this situation for the individuals involved here. From the perspective of a multi-asset investor, we've been risk-on since, I guess, for about 2 months now. And, of course, a very painful week for that position, a very painful day today. But at the end of the day, I'm not sure that changes the underlying macro situation. Coronavirus at its core is a natural disaster. And we can debate the depth of it and the extent of it, but the shape of it, insofar as it's going to create a steep downdraft to growth for the affected regions immediately, and then you make that back over the course of, you know, the next few quarters or even throughout the year this year, that has not changed. And so I think we're holding the line on equities. I would not say it's a buying opportunity given the uncertainty. And to your earlier points, I think it's emphasizing the key aspects of a coherent multi-asset portfolio in this environment. One of them is that Treasuries is your best insurance policy against downside risk here. And the way that Treasuries have been trading have just ratcheted down. Every time you get a sell-off, Treasury yields fall, and they don't bounce when equities bounce. And so from the perspective of where do you want to take risk, we like going overweight equities versus underweight duration. And the other thing I'll just mention is that, you know, the U.S. market, so S&P, is a sensible overweight versus other equity markets in this environment. The high ROE, the decent earnings, you know, the high quality market, that's exactly where you're going to see some protection during off days. And during this week, that's exactly what you saw.